The January 2024 approval of spot Bitcoin ETFs in the United States was one of the most significant events in the institutional history of cryptocurrency. Within 12 months of launch, the combined assets under management of U.S. spot Bitcoin ETFs exceeded $50 billion, with BlackRock's iShares Bitcoin Trust becoming the fastest-growing ETF in financial history. The approval resolved a decade-long regulatory dispute and created the institutional access infrastructure that many sophisticated investors had been waiting for. The contrast with futures-based Bitcoin ETFs, led by ProShares BITO, which launched in October 2021, illustrates the structural importance of the spot versus futures distinction. BITO attracted over $1 billion in assets in its first week of trading, demonstrating enormous institutional demand for regulated Bitcoin exposure. But BITO suffered from a structural drag on returns due to the mechanics of futures contract rolling in Bitcoin's typically contango futures curve, underperforming spot Bitcoin by several percentage points annually. For institutional investors, understanding the structural difference between spot and futures Bitcoin ETFs is not just a product selection question but a fundamental investment structure question with material long-term return implications. The spot versus futures distinction is the most fundamental structural difference in Bitcoin ETF product design. A spot Bitcoin ETF is essentially a Bitcoin trust with an exchange-traded wrapper. It holds actual Bitcoin in custody, and the ETF's net asset value tracks the Bitcoin spot price directly. The creation and redemption mechanism allows authorized participants to exchange ETF shares for Bitcoin, or cash, keeping the ETF price aligned with Bitcoin's market price. A futures Bitcoin ETF holds CME Bitcoin futures contracts rather than Bitcoin. This creates a return profile that is related to Bitcoin's price but systematically different due to the mechanics of futures contract rolling. When a futures position approaches expiration, the fund must sell the expiring contract and buy a new contract for a later expiration. In a contango market, where future-dated contracts trade at a premium to spot price and near-term contracts, this rolling process means selling at lower prices and buying at higher prices, creating a systematic cost that erodes returns relative to spot Bitcoin. The contango drag magnitude varies with market conditions, but has historically amounted to 5 to 10% per year in periods of strong Bitcoin contango. This means a futures-based Bitcoin ETF in a typical contango environment will underperform spot Bitcoin by 5 to 10% annually, which compounds dramatically over multi-year institutional holding periods. The futures ETF return drag calculation makes the structural disadvantage explicit. Starting from Bitcoin spot return as the baseline, each layer of cost reduces the futures ETF's return relative to what a direct Bitcoin or spot ETF investment would have provided. The management fee component is relatively modest, typically 0.95% for BITO. The roll cost component is the dominant variable and is dependent on the shape of the Bitcoin futures curve. In backwardated markets, where near-term futures trade at a premium to far-term contracts, futures rolling can actually enhance returns relative to spot Bitcoin. Bitcoin futures markets have experienced backwardation during bear markets when spot Bitcoin is under selling pressure from distressed holders. This means the futures ETF drag is not a constant but a regime-dependent variable that favors futures in bear markets and punishes futures in bull markets, which is precisely the opposite of what long-term institutional investors want. The practical long-term conclusion is straightforward. For institutional investors with long-term Bitcoin exposure mandates, spot Bitcoin ETFs are structurally superior to futures ETFs. The contango drag compounds over time, creating performance gaps that become very significant over 5 to 10-year institutional holding periods. The approval of spot Bitcoin ETFs in January 2024 eliminated the need to accept futures-based ETF structural drag for regulated institutional Bitcoin exposure. The BITO versus IBIT comparison illustrates why the spot ETF approval was transformative for institutional Bitcoin investment. For the 2 years between BITO's October 2021 launch and IBIT's January 2024 launch, BITO was the only regulated U.S. Bitcoin ETF option for institutions restricted to exchange-traded products. Institutions that needed regulated, exchange-traded Bitcoin exposure accepted the futures ETF structural drag as the cost of regulatory compliance. With IBIT and the other January 2024 spot ETF launches, institutions gained access to structurally superior exposure at a lower management fee. The 0.25% management fee for IBIT versus 0.95% for BITO represents a 70 basis point fee advantage before accounting for the elimination of roll costs. Over a 10-year institutional holding period in a typical contango environment, The cumulative performance gap between IBIT and BITO could exceed 50 percentage points of Bitcoin price appreciation, a massive structural advantage. The appropriate use cases for BITO after spot ETF approval are primarily tactical and short-term. Traders who want regulated Bitcoin futures exposure for hedging, short-term directional trades, or as part of a derivative strategy where futures-based exposure has specific advantages over spot. For long-term strategic institutional Bitcoin allocation, the spot ETF is now clearly the superior vehicle absent specific regulatory or mandate restrictions. The spot Bitcoin ETF AUM landscape after 1 year of trading demonstrates the dominant position of BlackRock's IBIT, which captured over half of total spot Bitcoin ETF assets. The concentration in IBIT reflects the institutional trust premium associated with BlackRock's brand, existing distribution relationships with financial advisors and institutions, and IBIT's superior liquidity as the largest ETF in the category. Fidelity's FBTC captured the second largest share, reflecting Fidelity's long-standing institutional distribution relationships and Fidelity's own Bitcoin custody infrastructure through Fidelity Digital Assets. FBTC self-custody model, where Fidelity custodies Bitcoin using its own regulated digital asset subsidiary rather than outsourcing to Coinbase Prime, provides a different custody counterparty exposure that some institutions may prefer. For institutional product selection, the primary differentiating factors are management fee, custodial counterparty, liquidity and bid-ask spread, and issuer relationships for large block trading. The management fees across spot Bitcoin ETFs range from 0.19% to 0.30%, a relatively narrow range where the fee difference is modest compared to custody counterparty and liquidity considerations. Institutions with existing BlackRock or Fidelity relationships should generally prefer the corresponding issuer's product for most efficient large trade execution and relationship management. The institutional Bitcoin ETF selection framework prioritizes the factors that are most material for institutional investors rather than retail investors. Mandate compliance and regulatory status are always the first filter because institutions operating under investment policy statements that predate spot Bitcoin ETF availability may need policy updates before accessing the new products. Custodial counterparty assessment reflects the lesson from the FTX collapse. Even in an exchange-traded product structure, the underlying custody quality matters for institutional risk analysis. The Bitcoin backing IBIT is in Coinbase Prime Cold Storage. The Bitcoin backing FBTC is in Fidelity Digital Assets custody. Both are regulated institutional custodians with strong track records, but institutions should verify the custody structure as part of product due diligence rather than assuming all spot ETFs have identical underlying risk profiles. The tax and accounting treatment advantage of spot Bitcoin ETFs is frequently underappreciated by institutional investors focused on return characteristics. Many institutional mandates have crypto-specific accounting and reporting requirements that create operational challenges for direct Bitcoin positions. Spot Bitcoin ETFs held as securities provide simpler tax lot tracking, standard security accounting treatment, and integration with existing portfolio management systems without requiring crypto-specific accounting modules. The January 2024 spot Bitcoin ETF approval was the most important institutional crypto infrastructure development since the establishment of regulated crypto custody. It created a new product category that meets the investment mandate, regulatory, and operational requirements of the broadest possible institutional investor base, including many institutions that were previously excluded from Bitcoin exposure by restrictive investment policies. The structural superiority of spot ETFs over futures ETFs for long-term institutional allocation is clear and well documented. The contango drag that impaired BITO returns from 2021 to 2024 is a predictable structural cost that spot ETF investors no longer need to accept. The management fee compression across spot ETF issuers, with BlackRock's IBIT charging only 0.25%, makes the institutional total cost of ownership substantially lower than the pre-approval alternatives. For institutional investors that access Bitcoin through futures ETFs before spot approval, the arrival of IBIT and FBTC created an opportunity to restructure their Bitcoin exposure into structurally superior vehicles. The transition decision should consider tax implications of realizing positions but should generally favor spot exposure for any institutional holding period exceeding 12 to 24 months where contango drag is expected to create material return divergence.